A Roth IRA is a tax-advantaged account, not an investment by itself. You put in money you have already paid tax on, then choose what to hold inside it, like index funds, ETFs, or individual stocks. Anything left as uninvested cash simply sits there, so opening the account is only the first step. Roth contributions are made with after-tax dollars and are never tax-deductible. That is the trade. In exchange, your growth and your qualified withdrawals later come out completely tax-free, which is the opposite of how a traditional IRA is taxed. For 2026, you can contribute up to $7,500 if you are under 50. If you are 50 or older, a $1,100 catch-up brings your total to $8,600. These figures usually move with inflation each year, so always confirm the number for the current tax year. To contribute, you need taxable compensation, meaning earned income, and your contribution cannot exceed the lesser of the annual limit or what you earned. There is no upper age limit, so you can keep contributing past 70 and a half as long as you have earned income. A non-working spouse can also contribute through a spousal Roth IRA on a joint return, capped at the couple's combined taxable compensation. Direct Roth contributions phase out by income. For 2026, single and head of household filers phase out between $153,000 and $168,000 of modified AGI, and married filing jointly between $242,000 and $252,000. Married filing separately if you lived with your spouse phases out from $0 to $10,000, and that range is fixed every year rather than adjusted for inflation. Inside the band, your allowed contribution is reduced proportionally. Earning above the phase-out does not lock you out entirely. Roth conversions have had no income or filing status limit since 2010, so high earners can contribute to a non-deductible traditional IRA and then convert it. Be aware of the pro rata rule. If you hold other pre-tax IRA money, the taxable share of your conversion is calculated across all of your traditional CP and simple IRA balances and reported on Form 8606. That means a backdoor Roth is not automatically tax-free. Withdrawals follow a fixed order. Your own contributions, your basis, come out first and are always available tax-free and penalty-free at any time. Conversions come next and your earnings come out last. So the common fear that Roth money is locked until 59.5 applies only to the earnings, not to what you put in. For earnings to come out fully tax-free, your first Roth contribution must be at least 5 tax years old and a triggering event must occur, reaching age 59.5, disability, death, or up to $10,000 toward a first home. The 5-year clock starts on January 1st of the year of your first contribution and does not reset when you contribute again. Each Roth conversion carries its own separate 5-year clock for penalty purposes. The 10% early distribution tax applies only to the taxable portion, your earnings or untaxed conversions, taken before 59.5 without an exception. Exceptions include up to $10,000 lifetime for a first home, up to $5,000 per birth or adoption, disability, death, qualified education, certain medical and health insurance costs, and others. Your contributions are never subject to this penalty. A major advantage: a Roth IRA has no required minimum distributions during the original owner's lifetime. You can leave the money invested as long as you live, which makes it useful for both long-term growth and estate planning. Traditional IRAs do not offer this. Open the account at a brokerage that offers Roth IRAs, confirm you have earned income and fall under the relevant income limit, then fund it up to your 2026 limit. Remember, you have until the federal tax filing deadline, around April 15th of the following year, to contribute for the prior tax year, not just December 31st. Finally, actually invest the cash inside the account and avoid contributing while over the income limit, since excess contributions trigger a 6% excise tax each year until corrected.